2023 was supposed to be the year of the bond in developed economies. We haven't necessarily seen that, and we see this huge demand for equities. Do you see a reversal here?
Well, first of all, bonds also have done well. I think the yield is here, the carry is here. Interest rates are volatile, and that also creates volatility for the bond itself, but they're actually doing quite well. But you're right, equities have done better. We actually think U.S. equities are a bit in la-la land, particularly on the tech side, very high valuation. And from here, either we have an economic slowdown, which will hurt earnings, and we see earnings slowing down. They're still reasonably for this earnings seasons, but they're all actually coming off. And if the economy is so strong, then what we will see that the real interest rates will go up, which also will hurt tech stocks. So from this perspective, we're a bit more cautious, particularly on U.S. equities, on tech stocks, and we actually would buy some of the laggards and high-quality names within the equity space.
And what about emerging markets, and especially those defensives as well that have, as you say, perhaps been one of the laggards in that space?
Yeah, interestingly enough, I mean, the economy is actually doing quite well. So some of the cyclical stocks are really lagging. Oil price is going up. Energy stocks are basically flat year to date. So these are some of the laggards. And then within the EM space, look at China. It's really a clear laggard. And if you want to buy tech names, then I will actually do it in China. We really see positive development on the policy side. There's enough liquidity, there's enough credit available, so they don't need to really stimulate more. But the government, and we see policymakers, are going into the area where they want to shore up confidence among private companies, among investors, and actually losing some of the restrictions. And I think that's exactly what the market wants to see. And we have seen very strong performance of China, and particularly some of the tech names over the last 1 or 2 weeks.
Yeah, does it feel like I guess, a proper game changer when it comes to sentiment for Chinese equities now?
Yeah, I think China was almost uninvestable in some eyes of some Western investors, and even internally at UBS, we have a big debate, of course, also with my colleagues sitting in Europe or sitting in the US. And yes, growth has been weak, and it's really low-quality rebound that we have seen so far. But I don't think stimulus can actually change that. What really can change is the confidence among investors, because we basically had a strike on the investment side. And I think Premier Li is doing a fantastic job on bringing this together. We have seen the Politburo outcome that they have dropped basically some of the sensitive basically statements that housing is only for living and not for speculations. And it's clear that the policymakers want to regain the trust of the investors, international investors, but also domestic investors. And I think that's key, and that's why the market is now starting to trade towards these positive news.
How much volatility should investors be bracing for? Because I think with the BOJ decision on Friday, and certainly even the session that came before it, there was a taste of, just how impactful any kind of actual policy change could be.
Well, in general, rate sensitivity has gone up. And I would say it's the most important indicator to watch for equities globally, if it's in Japan, in the US, even if you will, in China. So the rate sensitivity will stay high, and we need a bit more clear directions of where the economy is going until we see some stronger trends within the equity side and within the rate side. But you mentioned BOJ, for example. We do think they're moving in the right direction. They have started to loosen a little bit and moving a little bit away from the yield curve control. There's more to come, and there are really structural trends in Japan that will probably allow inflation to stay high. For example, female participation has now basically surpassed the one in Europe and the US. So this component of deflationary pressure has basically been addressed. And there's another component where sort of the lifelong employment contracts are now coming to an end as these people are retiring. So there's more volatility within the labor market as well in Japan, and that will drive inflation more structurally. And therefore, we actually do think the Japanese yen, for example, is a fantastic trade at this point.